Hi everyone, it's Mike from Order Flows and welcome to the Order Flow Dynamics course module number 9, the dynamic order flow trade setups. And for most of you guys out there, I know this is the module that you most look forward to in my courses on the order flow trade setups. Now, one way to accelerate your understanding of order flow is to provide you a group of objective trade setups that will facilitate your use of order flow. And the 7 setups I'll be talking about in this course is first the 5. The second is the OOPS POC. Number 3 is parallel bars. Number 4 is naked POCs. Number 5 is layering in. Number 6 is bid-ask ratios. Number 7 is the delta pair-ups. Now, bear in mind that this is probably going to be a long video because there's 7 setups and this is probably going to take over an hour to explain them all. And, a pattern in isolation, whether it's order flow pattern or, a price action pattern or anything, only tells part of the developing market activity. When you trade a pattern by itself and disregard the order flow surrounding the pattern, you often find yourself taking bad trade after bad trade. That's why understanding the order flow is going to be so important in your trading. All right, so the first setup is the 5. And what it does is it analyzes the internal order flow in a bar and looks for a sequence of growing order flow traded on the offer side in an up green candle, or a sequence of growing order flow traded on the bid side as the market is going down on a red candle. So how does it look? Okay, now not every bar is going to have a sequence of 5. And you can see here I put these little boxes around it. This is why I ask you guys to print up the modules, especially this module is going to be very important. Because, if you're looking on this course on your phone, it's going to be very difficult to see the numbers. And you're going to be analyzing the actual numbers inside the bar of the order flow. Not necessarily analyzing them, like trying to put them through some mathematical equation, but you're going to be looking for sequences, okay? So you can see here, as this market is going up, you have this green candle. Internally, the sequence starts at 11, goes to 19, goes to 21, goes to 45, goes to 93, goes to 120. So as there's offers here, it's being taken out more and more and more, right? And you can see here there's the next bar, you got 14, 44, 68, 85, 127, 149, 202. Now often in bars you're going to have sequences, runs of 3 numbers that are growing, like either to the upside or to the downside. Like in this other bar you got 14, 24, 74, 123, 152. This is another 5 right in here. Okay, now oftentimes, like I said, you're going to see sequences, here is just 76, 84, then 11, 22, right? It's not, the volume isn't symmetrical, all right? But you're going to be looking for these when they appear in a bar, because that's your sign that, even though there's aggressive trading, right? There's people buying the offer, people are, offering more staggered on the way up, and that's an important sequence actually. Here it is on the way down, right? Here's your red bar. You got 14, starts here at 31, 31, 71, 82, 93, 117. Okay? But like I said, getting a sequence of 5 is not going to appear in every bar, right? In the next bar, you've got a sequence 17, 26, 59. Right, that's 3. Then 45, 123, 153. That's only 3. Even on the way up, down here on the low, you got 21, 96, 13, 113. It's only a sequence of 3. What you're looking for is the sequences of 5. Here you have 10, 25, 27, 30, 43. Right, market's going up. On the way down, you got 9, 20, 41. 50, 68, 73. Even in the next bar, you got another one. It's back to back here. Comes in 9, 13, 16, 25, 78. The next bar has none. All right. The rest of these bars have none. So you're going to be looking for this. And when you see it, you got to trade it. And people are going to ask, how long do you hold it for? Well, it depends on the type of trader you are and the type of chart you're looking at. I'm trying to throw in different types of chart. This is E-mini 1-minute chart. E-mini 1-minute chart, E-mini 1-minute chart. Now we got a E-mini 5,000 volume chart. Again, not all the bars have it, right? But you have it here. Actually, in this bar, you have it twice. 20, 43, 48, 92, 202, 45, 46, 97, 180, 189, 240, right? And the market keeps going up, right? You don't have it here. You've got, I'll show you, I have one here, 61, 95, 151, 183, 217, right? You don't have it here, 81, 102, 204. Oftentimes, market's only able to string together 3, maybe 4 sometimes. Here, going up into a swing high, right? You have one going up, you hit the swing high, then immediately, right around the same level, you have it on the way back down. 4, 15, 19, 80, 88. This is crude oil, right? Earlier I was showing you E-minis, now I'm showing you crude oil. Here's mini Dow, right? Mini Dow, it is a market that doesn't trade a lot of volume compared to crude oil or E-minis. So the numbers are going to be lesser. Here's 1, 2, 9, 17, 24 right in here in this red bar on your move down. Okay, earlier you don't really have it. You got 2, 6, 14. You got 4, 9, 20. All right, you've got 6, 31. Then you got 21, 48, 20, 21. You don't have it on any of these other bars. Here on the way up, 6, 11. Sorry, 3, 6, 11. No. Here, 3, 8, 19, 23. That's only 4. So, when you see a sequence of 5 increasing on the offer side, or a sequence of 5 increasing on the bid side on a move down, those are your areas that you're going to be looking to buy or sell. And, it doesn't matter if you're a very short-term trader trading on a dome or you're trading, on a 1-minute chart, right? If you're trading on a dome looking for the next 2 or 3 ticks, that's a very good sequence for you to get your next 2 or 3 ticks. Okay, if you want to hold it a bit longer, if you're trading a 1-minute chart, you can. All right, you can see how it trades from the 600, 610, 26010 rather, all the way down in below 2600. Okay, so you could look for it on the chart that you're trading. I don't say you have to trade it on a 1-minute chart or you have to trade it on this type of chart. Apply it to your chart that you trade and see how often it shows up. Right? And if it's something that you can use, then great. So the 5 is preferred to use in markets that liquid times of the day. Okay, you can't use it on a 4-range chart or a 5-range chart because you're probably never going to get it. They do appear though on a 4-range chart because a 4-range chart has 5 price levels, and oddly enough, once in a while you will get it. Ideally you want bars that are going to cover more price levels. 8 price levels, 15 price levels. So I don't necessarily recommend it in the middle of the night session, at midnight Chicago time or 11:50, that time. Wait till a more liquid time when you have some decent volume because that's how I find it most powerful. All right, so the next trade setup is the oops trade. Actually, it's the POC oops trade. And someone once mentioned to me, hey, you should call it the poops trade, but it's better to just call it the POC oops trade. And if you're not familiar with the oops trade it's basically you buy when the market opens below the prior day's low and comes back into that low, you buy. Or if you open above the prior day's high and come back into that high, then you sell. Now the POC oops trade is similar in the sense that you open below the prior bars POC, and close above the prior bars POC. That's where you're looking to buy. For sell, it's the opposite. If you open above the prior bars POC and close below the prior bars POC, that's where you sell. Now this is a short-term trade, and it's really geared more towards scalpers, people trading on a dome, because it's got some momentum to it. All right, so let's take a look. And I just highlighted a few of them here. Okay, so this first one, right, this red candle down, we opened above the prior bars POC, closed below it. Okay, you can see the next bar, we opened above, but we didn't close below, so there's no trade there. Here, we got the prior bar, we closed below, we opened below and closed below. Here we opened above, closed above. Now here we opened above the prior bars POC, which is right in here, and we closed below. All right, now here we opened below the prior bars POC, closed above. All right, so you're just looking for those quick hits, in and out, hit and run trading, so to speak. It's another example. Okay, we got the green bar, we open above the prior bars POC, close below, right? Boom, next 2 bars lower. Here, we open below the prior bars POC, we closed above the prior bars POC, next 2 bars up. Now there's going to be bars like this where we close below the prior bars POC and we open below, right? That's not a trade. Like this green bar, we opened well below the prior bar's POC, but we still closed below it. Okay, this green bar, we opened above the prior bar's POC, we closed above it. There's no trade there. Okay, here's another example, right? We opened below the prior bar's POC, we closed above it. That's your trade. When we open right on it, it's usually not a trade I'm looking to take. I'm looking for a clear open and close above. You know, when it opens right on it and closes above it, to me that's not a clear indication of the trade to take. You know, here we open well above the prior bar's POC, we close well below the prior bar's POC. You know, talking about borderline, you know, here's one tick above, but we close right on the POC. You know, even though it worked out, you know, I tend not to take those trades, right? I want a clear one like this one on the high, right? This one opened one tick below. Again, you know, you could take it, but it clearly closed well above the POC. Now, the OOPS POC is a scalper setup, right? You're trading the next bar or even the bar after that. Can it be held longer than one bar? Yes, it can if the order flow is dominant in a direction. Again, you know, read what's happening in the order flow, right? That's why you use order flow, keep you in trades longer. For example, if you get short and the bar closes on the low, or you get long and the bar closes on the high, and you're seeing imbalances coming in, by all means stay in the trade. Okay, so the next setup is parallel bars. And what these are consecutive bars where both bars look the same. Okay, it's got to be back to back. The second bar can be a tick or two above or below the first bar. Not more than, you know, 3-4 ticks like that. Forget it. It has to be, you know, within a tick or two above or below the low of the previous bar or the high. And the signal's effort is being made for continuation or reversal. Okay. Watch the third bar for confirmation of direction. Now, parallel bars, if you're familiar with, you know, the 2-bar flip, right? In the 2-bar flip, it's very similar to parallel bars. There's a strong upthrust bar giving the impression of strong demand. The next bar opens a little lower and sells off all bar, closing near the lows. Now, on a 2-bar flip, you have one big solid green up bar followed immediately by a big solid down bar. That's the 2-bar flip. But I'm saying parallel bars, you can have a flip or you could also have it in the same direction. Okay, so parallel bars, all right? You can see here, we got a big, nice down bar followed immediately by a big up bar. Opposite direction, bar down, it's got 1, 2, 3, 4 selling imbalances. On the way back up, you got what, 2 buying imbalances, okay? So what was looking bearish all of a sudden reversed and all of a sudden is bullish, right? Go in the direction on the third bar. If we break to the upside, it's up to the upside. If we were to break the downside, it's to the downside, right? These bars look exactly the same, but mirror images of each other. All right, you see the parallel bars here, right? You see 2, right? You see this one here, right? Followed by the nice sell-off, right? There's one down here. Does it start ticking up? No. You know, it gets one tick above, then it just sort of goes sideways. Even if you took this trade by the second, the third bar, and if it's not going in that direction, you cut it, right? You look for the ones that are going to make those moves. Okay, this I would not consider a parallel bar. That's one over here because it's one tick above, it's 3 or 4 ticks below. You know, ideally you want it to be exact same height, but you know, I could take it with, you know, 1 or 2 ticks above or 1 or 2 ticks below the previous bar. Okay, here, parallel bar, right in the middle. Now notice the next bar, there's no follow through. Okay, it just goes inside. You don't take those trades, right? You want the next bar to start the move of breaking out of this little range, so to speak. Okay, you don't have anything here like that, so there's no trade, even though this is a parallel bar setup. Now, parallel bar, remember, consecutive bars that appear as mirror opposite. You know, first bar green, second bar red, or first bar red, or second bar green. All the effort was made in the first bar seems erased by the second bar. Watch how the order flow goes in the next bar's direction. You know, there's going to be rare instances. I don't know if I have an example here where it's exactly, two green bars at exact the same level. But I mean, those are rare, but if you do see them, still trade them the same way. Okay, here, parallel bars. Again, it exceeds it by 1 tick. The next bar, you exceed the highs by 2 ticks. It's off to the races. Okay, boom. It's starting to move in that direction. If this next bar only exceeds it by 1 tick, I don't like that, right? I like to see movement by 2 ticks above the high or the low of the signal bars. Okay, where here? Right in the middle. Boom. Parallel bars. Green up bar, red down bar. It only exceeds it by, this one's 3 ticks, but it's a long bar, so I'm willing to make adjustments. Again, if you're looking at, say, NASDAQ, right? NASDAQ trades, you get, on some bars, you can get 30, 40 ticks, price levels. So if it exceeds it by 3 ticks, 4 ticks, but the bar is so long, I'm okay with that. Okay, depends on the market conditions. In volatile market conditions, sometimes you overshoot, but generally I like it to be 1 to 2 ticks. But again, this is a bar from, what is that, like 31.61.5 down to 31.56.5. So it's quite a long bar, both of these bars, right? If this bar was, say like this little bar here where it only covers 8 price levels and the next bar covers 16, no. But if this bar covers 16 price levels and the next one covers 19, okay, I'm willing to accept that. Okay, now parallel bars, keep in mind, are not engulfing bars, right? Engulfing bars, you'll exceed both the high and the low of the previous bar by a few ticks on both sides, right? This is not an engulfing bar. Okay, naked POCs, naked points of control. It's not about taking your clothes off. They are POCs that have not been traded back to. So when 2 bars in the same direction with naked points of controls, again, 2 bars that the points of controls have not been retraced back to, appear, look for a rotation back to the second naked point of control on the 4th or 5th bars to enter into a position to go with the trend. So basically, you'll be buying so you can have a nice low risk trade, right? You can be buying on a pullback, you can be selling on a pullback. And it's most effective on time-based charts than range-based charts because, range-based charts, it doesn't appear as often on range-based charts, I think, because your market, it's a range-based chart, so markets are already moving, and you don't immediately get that pullback over the next 3 or 4 bars, right? Because you're looking on the 4th or 5th bar to enter into position. I'll show you on a chart. It'll make a lot more sense. Okay, so for example, here's your naked POC right here. Okay, you got naked point of control, naked point of control. The 3rd bar, 4th bar pulls back to that point of control and then continues in the direction. Okay, when you're looking on a range-based chart, oftentimes since it's based on a range movement, right, as opposed to time, you could get, oftentimes you see bars just jumping in one direction, right? Like here, right? This is a 1 minute chart. You go from 38 down to 28 basically, and on a 10 range chart, it's just not going to pull back on a move like this. Okay, so you see the naked point of control here and here, right? Where is the pullback, right? Here's the pullback right to that point of control. Now, you got to remember, right? You're trading a pullback. The market could pull back further. Okay, so where are you going to place your stop? Me, I prefer to keep my stops on these types of trades pretty tight. I'll use a point to 1.5 points, right? But I know that if we get that pullback here, I could be looking at, 3 points. All right, getting long here at 74.5, or is a trade up to 75.5. Okay, you see your naked points of control? Probably not, right? The reason is a range-based chart, right? And you see how it moves a bit different, right? Here you got a naked point of control. This one's not. This one's not. Naked point of control. Naked point of control. Keeps going down, right? It doesn't retrace back up in there. Naked point of control. Not a naked point of control. Naked. Not naked. Naked. Comes back in here, but you don't have a previous one. Naked. Not naked. Not naked, not naked, right? It's just, on a range-based chart, it just doesn't really appear that often because, you get those immediate price squirts in in range-based charts that you don't see in time-based charts. Okay. Now, one thing you gotta be careful of with naked points of control is when you run into what I call tight ranges, right? Here's 1, 2, 3, 4, 5, right? So you got naked point of control, third bar, fourth bar, fifth bar. But this range is very tight, right? You're talking point of control by 2 ticks higher, right? By 1 tick higher. This moved from 10.5 to 11.5, right? It's a $1 range. When normally, right, the bars can move, in a dollar movement. So it's just bunched a bit tighter. Oftentimes you're going to get a pullback that can come right through the naked points controls and stop you out. So, personally, I think it's better on bars that have a little bit more movement than bars that are putting in that tight movement here. Okay, where do you see it? Right there in the middle. Right, you got naked point of control, naked point of control. Then you came back in here, pull back, fill that in, and go up there. Now this is a range-based chart. Okay, the 4 range chart, you hardly see it. 10 range, you see it rarely, but it does appear on range-based charts. Generally, when you go into a shorter range chart, the market makes the movement faster. 10 range can rotate a little bit more. Here's again is a 10 range. I did want to show you how it appears on 10 range charts. Here, it's coming in right here. Okay, takes some while to getting used to, right? This is a case where it pulls back a little too much, right? You might have been stopped out here. Okay, now you got naked point of control, naked point of control. Third, fourth, fifth, it pulls right back to that point of control here and rotates back up. So naked point of control has sort of its beginnings in the understanding of rotations, right? Markets are rotating, right? It's rotating, market moves up, it rotates back, moves up, rotates back, right? So once you understand rotations, you can understand the naked POC setup a bit. Again, just really quick, understanding the market rotations, right? Here, right? Selling off, naked point of control, rotates back up here, covers it, and then continues its move back down. And here you got naked point of control, naked point of control, naked point of control. Here you got naked, comes back in, and it just keeps rotating back up. So again, be careful, right? Especially on a range-based chart, the market can move a lot faster, I think, than a time-based chart in terms of price movement. Now, thing to remember, if the naked point of control is not retraced to by the 4th or 5th bar, then it's often going to keep going in the opposite direction. Okay, here's an example of a POC fail, naked POC fail. All right, so you got naked, right? But I'm really going to be looking at the 2 most recent. So you got 1, 2, then 3, 4, 5, right? And it just keeps going down in that direction. Any sort of trade setup that gets in on pullbacks, this is what you run into, right? This is a problem that you can run into anytime you're trying to trade pullbacks. The market can keep pulling back. Okay. Now, naked POC, what if there's a trail of naked POCs? Which one to trade? All right, I just sort of explained that. Is you trade the most recent ones. Okay, what do I mean by that? Is here's a naked POC, Okay, you came back, you filled it. Then you got naked. Well, which ones do you trade? Well, you're going to trade these 2, right? Just as on the way down, right? You got naked. Okay, well, which ones are you going to trade here? You're going to trade these 2, right? And it came back here, made a little rotation down before pulling back into it. So again, which ones you're going to trade? You're going to trade the most recent ones, right? You got naked. But you're going to be trading these 2 right here, right? All right, so you're going to be trading this one, not this one, not this group here, not this group here, because you haven't retraced back. You're going to be trading the most recent ones. So you're going to trade these two here for this pullback right in here. All right, so the next setup is layering in. And layering in occurs when buyers join bids and moves up, where they absorb the selling pressure as the market moves higher, right? Or in markets moving down as big sellers offering supply by joining the offer, absorbing all the aggressive buying. You know, you want to see it, ideally you want to see it coming in a pullback, but it's not always going to appear in a pullback. It can occur in an existing move. All right, and I talked about these before in a different sense, right? If you're familiar with my imbalance reversal on the order flows trader software, it looks for this in certain areas in a bar, but what I'm talking about covers the entire bar. And if you're part of my inner circle, I talk about the second slot imbalance. That's an imbalance in a very particular spot. Layering in occurs anywhere in the bar, okay? And you'll see on the examples what I mean by anywhere in the bar. Now there's different ways to look at it. Okay, you could look at it on a normal footprint chart. You could look on it on a delta footprint chart. And this is what it looks like on a delta footprint chart, right? That's why you don't see bids and offers on every side. But you can see on this bar, right, this red bar, you got 1, 2, 3 buying imbalances, right? People are layering in offers. Now, again, this is a delta imbalance bar, so it's the net difference between what was traded on the bid, what was traded on the offer. So people are offering it out on the way down, right? So on the way up, there were some offers, but then they're putting their foot on the neck of the market, so to speak. No reference to George Floyd there, but what's happening is they don't want this market to keep going higher, so they're willing to offer it out. Aggressive buyers. People say, well, there's only 19 traded. This is the delta, right? It's the difference, so you don't know what the difference was there. 54.83 as the market is moving back down. They keep offering it out, putting pressure, selling pressure on the market. They're not hitting the bids, but what they're doing is they're offering it, right? They're layering in offers into the market to stop it from rising higher. Okay. Layering in, right? You can see it right there. Okay. Market's selling off, comes back up, they're offering it out. The clue gives it away is this 98 against 458, right? Market continues down. See if you can spot it. Okay, there's a spot right here, 511, offering it as the market is coming down. They keep offering it out, right? People are still, people are buying it here, right? They're thinking, hey, this is a good buying opportunity. Now I could buy it at 66, where before I was trying to buy it at 67. I could buy it lower, but people are still offering it out. Market sells off, right? Get down in here. You got another one, right? This time's a buying one, right? Then you run up into the selling one, right back up here. This one you didn't get any market really reacting to it, just sells off by a few more ticks in the next bar and then mostly goes sideways. But again, it's not always going to be, the monster moves and the 10 point, 15, 20 point move. Again, it depends on how you're trading also, right? Most of us are short-term traders. We're looking at least for the next 4 or 5 ticks, preferably more, but you can only trade what the market's giving you. Right here you could have got something out of it. This one, not really. But this one, most definitely. Okay, layering in, right? This one's a bit spread out, but this one is beautiful, right? You see here, the selling imbalance, selling imbalance, selling imbalance, right? This one I'm not too concerned. It's 5 against 1, but here 140, 58, 64, right? As the market's going up, right? People always ask, how can the market go up on negative delta, minus 16, minus 126, minus 46? So people are layering in their bids. They're supporting the market, right? Oftentimes, personally, I think that when you see it in the second slot, that's the most powerful. But, there's been testing that we've been doing, and it's just as powerful when it appears mid-bar as well, okay? So pay attention to those. Now here's an example of layering that failed. All right, you see it stands out right here. You know, it started to move, then it just came right back up. Then there was another attempt right in here, the 64. Okay, now again, you know, 23 against 4, not so much. You know, this one was decent here. And let me talk about imbalances for a second. Okay, so imbalances occur, you know, when there's more aggressive buying than selling, or more aggressive selling than buying, by a certain ratio, 4 to 1. But you should also keep in mind is a volume requirement. Okay, 103 is significant. 3 against 46 is significant. 5 against 20, 5 against 21, is that significant? I wouldn't consider that significant. Okay, I want solid numbers. You know, 4 against 23 is very similar to 5 against 21, right? But when I see 2 against 103, yeah, I like that a lot, even though this one started to sell off and then came right back. 8 against 64, yes, I like that a lot. But when you start running into smaller numbers, you know, below around 20, below 25, you know, it's just not, in my opinion, not that powerful. But again, that's me. You got to find your own levels and stick with them. Okay, so you've seen a few here, right? So this is ones. This is a 4-range chart. You know, the 617, it does, you know, it's a nice volume. 517 rather, comes off a little bit. Not that great a move. Then here, same level, 1,000 contracts. Okay, over here, 900 contracts. These sellers are anticipating lower prices, so they're happy to move that size there, work an offer. They're happy to sell it there. All right, they're not hitting the bid. They're not panicking, saying, "Oh my gosh, I got to hit the bid." But they're like, "Hey, you know what? This is like free money. I'm long from earlier. I'm happy to just go layering in and get out." Now, one thing to realize with any trade setup or any order flow analysis is be careful around data releases. After the data release, big traders are going to be throwing around size in markets that aren't very liquid. And what I mean is, you know, the bid offer dries up and then someone all of a sudden got 100 contracts to buy or sell, and they just throw it in there, you know, in hopes they could get filled. Someone else will hit it. You know, they're taking advantage of volatility. Be careful in your analysis around that time. Preferably, you know, around big data releases, I prefer to just to sit it out. Let the market calm down, get back to normal. All right, so be careful around data releases. Okay, but here's some more examples of layering in. Okay, when I see more than 2 examples in a bar, I get really excited. Here, you know, there was one here, and then another one here. These are shorts. There was a long here. I just don't want to highlight it because it's getting too many arrows on there. But when I see 2 in a bar, you know, that really gets me going. I find it pretty powerful, actually. Again, there's another one here. Again, you know, 24 against 109. Is it strong? Yeah, I could take that. You know, but ideally, I would like slightly higher numbers. But again, if I'm seeing a couple in a bar, even though this is 109 and this is 126, I like that as well. I know there's not necessarily a lot of volume being transacted on these offers here, right? As this market is selling down, where's the counter trade? 55 against 1, 87 against 30, 78 against 49, 187 against 96. There's not a lot of counter trade going on in there. Whereas here, you know, you see decent counter trade, 327, 191, 135. But these are actually the big volume areas here, right? Other than the 246 where your point of control is coming in. This is like your second and fourth most highest volume levels in the bar. So that's important. Again, you should don't set a volume threshold in sand that you can't deviate from. You know, being a good trader, you got to be able to understand what you're looking at in the market. Here. Okay, well, again, you know, people say, well, Mike, you just said on the previous slide, you know, 50 is not a lot, 83 is not a lot because it's below 100. Okay, well, you got to take it in context with what's going on. Here you have it at the top of a bar at a swing high. Okay, at a swing high, you often don't get a whole heck of a lot of volume. Now the market's starting to sell off. You got a single print up here. It's telling you these prices are being rejected. It's below the previous bar's prominent point of control. And this bar, this 83, is your most volume at a price level in the bar. So even though I said, I don't like volumes less than 100, if it's the most volume, even though it's less than 100, but it's 83 is the most volume in the bar, then I like it. Okay, you gotta, sometimes people get so married to statements that they can't put two and two together. All right, I don't like it like when, if you say, well, it's only 109. Okay, well, every other price level is trading above 109 basically, except the top and bottom, which you generally have the least amount of volume on the top and bottom. But 109 is the least amount, the third least amount in here. 114 is the most least amount, right? Everything else is well above 109, right? But when you're looking at this and it's 83, it's like, well, it's less than 100, so I can't take it. But it's the most volume in the bar at a price level, right? It's different. All right, so hopefully you can understand what layering in is now. Now, the next setup is basically the bid-ask ratio, okay? And it's the bid volume versus the ask volume. Now you have to add this to your footprint chart. It's available on most footprint charts, as the information is available. It's whether or not you look at it. And I like to look for a ratio of 2 to 1 for potential directional moves as well as follow through in the next bar or bars, right? Now remember, 2 to 1 is not set in stone. I could take 1.95 to 1 or even 1.8 to 1. Ideally, I like at least double, right? But that's not to say that you can't take 1.5. Again, it's up to you. Find the level that you like, dependent on the chart that you look at. All right. So, for example, this is the bid-ask volume down at the bottom, right? You could have the ask, the bid. Again, it's going to show up around the delta, the max delta. You're not looking at deltas. Bid-ask volume results in the delta. Okay, so here is a case right here. Look at this. The ask volume is 532. The bid volume is 268. Now, this is not 2 to 1, right? If it was 2 to 1, that'd be 268 times 2 would be 536. It's within 4 ticks or 4 contracts, okay? Even though I said look for 2 to 1. 2 to 1 is not set in stone. That's why I started off with this. I would take 1.95, even 1.8. Okay, and you can see how the market reacted because you're coming in here at kind of a swing low and you got twice as much aggressive buying than aggressive selling. It's almost like an imbalance of the bar. Imagine that way. Bid-ask ratio, right? Don't take when the POC is on the bottom of the bar, right? That's going to be stopping volume. And what do I mean? Okay, there's an example right here. Okay, you can see what's happening, right? This bar, point of control right on the bottom. Look at the volume numbers, 122 versus 339. Okay, so 122 is, or 339 is more than 2 to 1. But what you have is the stopping volume coming in there. All right, what you want is the point of controls, somewhere in the middle of the bar, ideally, like here. What you have here is stopping volume. And the reason why you got such a big, bid volume is because there's a big bid there. And people are selling into it. Even though the bar is down, it's stopping that move from going lower. Okay, when you see that at the bottom of a red bar or at the top of a green bar, okay, that's one of the caveats, right? That's stopping volume, right? Remember what I said earlier in one of the earlier modules. Vertical moves are stopped by volume. Okay, so in the bid-ask ratio, just as in any order flow thing, you want the next bar to move in that direction. If not the next bar, the bar after that. All right, so let's take a look. Let's take it apart here. So what do you got, right? Here, you got 97 and 236, right? More than double. All right. What does the next bar do? Nothing. Goes one tick higher. Comes back inside. Next bar, also nothing. Doesn't even go any higher. Right? That's not a good trade to take. I like to at least let it go 2 ticks higher. Right? Here, earlier, 46 versus 105. Again, the next bar does nothing. But the next bar gets within the 2 ticks, breaks out of it, and goes up. Here, 54 over 106. Or sorry, 106 over 54. Next bar breaks through, right? That's what you like to see. Even though, people say, well, it's 108 if you double that. Again, I told you earlier, around 2 to 1. It could be 1.8. It could even be 1.7 if you want. Well, I'll probably show you later, if you look at volume-based charts, it's very precise. You can very rarely on volume-based charts are you going to get a 2 to 1. So you might want to look at 1.75 or even 1.5 to 1 or 60% more. But again, look for the market to move in that direction. And again, you want it to go in the direction. Here's an example. Here's 31 and 72. Okay. Here's 49 and 98. Is the market moving in that direction? This is to the downside. It's pressure to the downside. So you're going to be looking for the market to come off. On 49 versus 98, it's not. It's not making that move. The 31 versus 72, yes, the next bar here is making that move. Okay, so where are we here? Bid-ask ratio. Again, you're looking in here, right? You're looking inside here for those numbers. Okay, here it's not making the move, right? Put the arrow here, right? 68 versus 189. You're looking for the market to sell off. Next bar doesn't exceed the low by at least 1 tick, right? That's not a trade to take. Here's 194 versus 545. Next bar starts moving. This is where you're getting short right here. Right here. 2 ticks below. And you catch that move down. This is, I said this is about as close as you could get. Right here on the low. It's 112 versus 215, right? That'd be 214 to 215 if you double it. Okay, double 112, you get what? 214. But again, look for the next bars to move, right? This next bar only 1 tick up. This next bar nothing. Eventually it did go up. This is a trade I probably would have passed on. Here, 137 versus 459, right? A short. The next bar made that move. That's your trade. Now, here it is on volume-based charts. Okay. Now, where are we here? All right. So, again, very rarely on volume-based charts are you going to get a double, 2 to 1. There's one here, but I want you to see it. Normally, on volume-based charts, it's pretty evenly distributed. There's a couple on this chart, actually, even though after I just said it's usually evenly distributed. 326 versus 674, 318 versus 680. You can actually know if you're trading, a 1,000 volume chart, you can figure out what the math is going to be. So you're just going to be looking for it, whether it breaks the threshold or not. But generally on volume-based charts, it's pretty evenly distributed, right? I just threw this up there because that was a case where 2 of them actually appeared. You could go like a day even on a volume-based chart with nothing appearing. Now, when you get to bigger volumes, okay, you expand it a bit. Fishing is a little bit easier sometimes, but again, oftentimes on volume-based charts, it's pretty evenly distributed. There's just one here on this chart, right here, the 616 versus 1318, 1384 rather, as the market pops up. Now, liquid versus illiquid markets. Okay, it's a 10-year chart. 10 years are highly liquid. Okay, during the US trading session. And you see some in here. Okay, actually you see one here, you see another one here, bearish one that didn't follow through. Now, the problem with very, very liquid markets is, things like treasuries, they move, but they don't move as quickly as other markets like E-minis or something like that. So, if you're looking for the next bar to move, 2 ticks, oftentimes you're not going to get it, right? Oftentimes what you see is a lot of this sideways action and it just sort of grinds higher. So you probably want to change your chart setup, from a 5-minute chart to a 4-range chart or something different like that. Even though it trades a lot of volume and it is moving in that direction generally, here you got another one, 5.9 versus 1100. It's not making those movements. So this is a case of being too liquid. It's too liquid that it's constricting its movement. Now here's an example of no liquidity. Okay, and often in markets with no liquidity, not in the sense of there's no decent bid and offer, but the market's not moving, right? I should strike that from illiquid to quiet time, or something. What do you have, right? You're trading just the offer side for the 5-minute period, or you're trading just the bid side. So it's like 76 against 0. 0 against 235. Well, that's obviously more than 2 to 1. But the reason is it's 11 o'clock at night, Chicago time, right? There's nobody trading this right now. 0 against 2. Oh, that's 2 to 1, right? Because you got 0 against 2, literally. Yeah, but nobody's participating, right? You want participation in the market rather than me buying 2 contracts showing up for the world to see. Okay, now on a 4-range chart, I think it becomes a bit easier to see than on the 5-minute chart, right, on a more liquid market. Okay, because now you're looking at price movements on the chart versus time movements on the chart. Okay, so here you got a nice one at the low, right? Well, 6.7 versus 14,000. So again, try to get your head around the type of chart that you're using and how the chart is formed, right? But this bid-ask ratio is actually a very powerful tool. We're currently working on a program to trade certain markets specifically using this analysis, and it's quite powerful. Now, delta pair-ups. Okay, you could have back-to-back big delta, back-to-back small delta. And what that means is back-to-back big delta bars are a sign the market may go sideways, especially when they occur after a directional move. What happens when bars put back-to-back big positive delta bars after a move up is a lot of aggressive buyers came in late. It's often a sign of FOMO, right? If you're long for lower prices, now is a good time to take profits. So you got 2 different types of traders thinking. People that got in late thinking, oh my gosh, I gotta get in. They're aggressive, and people that were long from lower, they're looking to take profits. There's a tendency for a market to move sideways or even reverse after back-to-back big delta bars. Now, what's considered big delta? If the delta is about 10 to 20% of the volume, right? So let's take a look here, right up here, back-to-back big delta. Now, it should be said, back-to-back in the same direction, right? What happens? Market's gone up, boom, then it goes sideways. Okay, volume is a little bit heavier than normal, 6,200, 4,009. But earlier you're putting in 7,000, so it's not dependent on the volume. It's dependent on the delta. Right, the move is stopping. Okay, back-to-back big delta bars. Okay, there's big negative delta right over here. Whoops, sorry. It's right here. You can see the 331 and the 685. People say, well, about the 216 and 335, 331? That's not overly big because you're putting in earlier bars, 200, 300, 200, 200, right? But this 331, it sort of exceeds the envelope. The 685 is definitely big. What happens is the market stops, and reverses. Okay, don't get fallen into this trap. Oh my gosh, I got such a big delta, I gotta get short. Right, that's what a lot of people are looking at. Oh my gosh, we're coming off a high, we got such a big delta, I gotta get short. But wait a second, how is it in relation to the previous bar? Right, if it's pairing up big numbers, be careful. Now here you got some pair ups right here, 707, 561. All right, there's still a little bit more a little bit more movement to the market. Here you put another bar with big delta, but doesn't pair anything up. Okay, but if you're long, this is where you're going to be getting out in here, right? When you pair up the back-to-back. Yeah, you do give up a little bit extra, but more often than not, the market is going to go sideways. I mean, it can keep going, but more often than not, the market movement is going to stall out, right? So that's, it's more of a trade management thing actually than a trade setup. But, when I get into the small deltas, the back-to-back small deltas, you'll see here, right up here at the high, 272, 188, right? What happens? Market goes sideways. You're not thinking, oh my gosh, big delta is right up here, I gotta get long. No, you take your profits. Okay. The back-to-back big delta needs to be in the same direction. Here's the opposite direction, minus 1,000 and plus 1,000. Then you get up here, back-to-back big delta, 1250, 828. Right in here, as you hit the high, you do get another delta of 116. But you're looking for it to start coming off, right? Don't get long here, right? Instead, actually, you could be reading what's happening in the delta. It's a great short opportunity because you go 1250 to 828 to 116 to minus 600. That's a great short. The aggressive buying is weakening and aggressive selling is coming in as the market's selling off. So back-to-back big delta, although not a trade setup per se, but it'll help you manage your trades on where to get out. I know people, they specifically look for back-to-back big deltas as an exit point. If they're in a trade and they see back-to-back, they get out. Now, back-to-back small delta bars are easier to spot because they stick out more and are more optically visual. They stick out more. I forgot the word out. So you're looking for consecutive bars with very small delta, either positive or negative. You have to understand what is considered small delta in your market. Generally, any delta of 10 or less or 20 or less in most markets. Now, on markets that trade a lot of volume, you might consider 50 or even 25 small delta. And a misconception is small delta is a sign of absorption, but it's often a result of small volume. Right? It doesn't necessarily have to be absorption. I know some people have this blanket thing where they see small delta, they think it's absorption right away. But it could just be a result of small volume. So look for a breakout of recent swing highs or lows, not a breakout of back-to-back bar ranges. Okay, so what does that mean? How you're going to trade it is you're going to be breaking out of the swing high or swing low, not the two bars with the small delta. Alrighty, let's put it in here. So here we go. Now remember, when I talk about delta right before in a lot of my analysis, when you get to a small delta, I treat it as neutral, whether it's minus 5 or positive 5, I don't care. It's within this absolute value of less than 50 that I treat it as neutral. And when I see back-to-back ones like this, 13 and 5, it doesn't matter if it's positive 13 and minus 5, I group it together. I'm going to look for the breakout of the swing low. Swing low is here, right? And we broke out down here, you get the move down. Stopped with the prominent point of control, but still the way you trade it is to go down, the market to go down. Now this is E-minis. This is a 10 range chart, okay? And on this chart I'm saying 100 contracts is considered small, right? Why? Because you trade thousands of contracts per bar. So you got minus 99, minus 64. Here's your swing low, here's your swing high. I'm going to look out for a breakout here or a breakout here. Right? This came to the breakout to the downside, the market moved down. Right? Look for the breakout of the swing high or swing low, not of the two bars with the small delta. Right? Two bars here, you're looking at the swing high or swing low. Okay, here. 84.39. Where's the swing high? Up here. Where's the swing low? Right here. Right? We break out from the swing low. The swing low, again, it's not the bars with the small delta. It's right here. It's a few bars earlier. All right? You break out of that. Now you can also argue that there's, or not argue, you can also say here, you also got to break out here. Okay, you got two small deltas, 23 and 50. Here's your swing low. Right? You break out. This is where you're getting short as the market's going to continue to sell off. But you trade the swing high or swing low. That's your entry. Now you want them back to back, not spread out. For example, here. Okay, you got 1, you got 50, you got 27, 50. You want it to be, you're not going to group the 1 and the 50 here. You're going to look for like the 50 and the 27 or the 27 and the 50. Okay, or sometimes people say, we got 20 here, you got 31 here. Okay, I'll group that. No, you want them back to back. I mean, here you got several, right? 50, 27, 50. Okay, and again, how are you going to trade it? You swing low here, you swing high here. Look for the breakout there, right? The breakout is here at 31.60. Okay, and it breaks out to the downside. Your stop's above the swing high, but you're short, right? The market's moving in that direction. Swing low is where you're going to be taking the breakout. Okay, back to back, small delta. Here, -3, -5, and even here at 47. But again, you're probably going to take the most recent two, 3 and 5. Swing high here, swing low here. Swing high, swing low. Okay, you break out the swing high from 13.01 all the way up to 13.13. Swing high, small deltas. Trade this breakout. Boom. All right, so hopefully by now you see the different order flow setups, right? Remember, certain order flow setups allow you to sell into market strength and buy into market weakness without emotion, right? No matter what is happening in the news, technical analysis, fundamental analysis, or any other price-based indicator, right? Ideally, you want to remove emotion, right? You want to read the order flow for what's happening in the market. Order flow is actually the emotion of other traders, but you want to remove your emotion from the market. Most trading setups deal with trend reversals or trend continuation. Very few setups deal with trend beginnings, right? Often trends start with a bang, so to speak. So a big order hitting the market out of nowhere is something that can start a trend. And you're going to look for it in the order flow. How do you see it? You see a sudden jump in delta, imbalance in one direction. Where to look for it? Well, if you're looking for a reversal, if the market is trending down, you look for buys. As the market is trending up, you look for sells. That's how you trade reversals in the order flow. You're looking for certain things in the order flow. And, I just briefly talked about one of them earlier with the delta, the big delta getting smaller, right? As you're going up to the high, delta was decreasing. And then as you hit the high, delta started increasing on the downside, right? That's how you look for a trend. As the market was going up, you look for reasons to sell in the order flow. So once you have a trade set up, you want to build a trading plan around what you have, a reason for taking the trade. Right? Then you can wrap it around your own trading style, adapt your money management and risk management. And more importantly, it's going to let you relax as you know how much you can risk, where your potential exit level is. And trading relaxed makes for much better trading results, right? Trading anxious and trading like, without any sort of plan is going to give you stress. And when you're stressed, it's hard to trade, whether it's stress from your trading plan or stress from your personal life. Don't trade stressed. Okay, trade with a level head, and you should do fine. So this concludes module 9. In module 10, I'm going to discuss risk, money, and trade management to help you improve your trading. So I'll see you on the next module. Bye bye.